Welcome to your CIMA F1 Financial Operations Chapter 3 from your Express Notes. I would like to provide you some highlights on the substance, which is in effect substance over form, a key accounting concept, as well as IAS 18 revenue, which would cover revenue recognition mainly. If you are at Chapter 3 in your Express Notes, you have there an introduction of substance over form, and in simple terms, substance refers to the commercial sense of the transaction, and form pretty much means the legal form. And when we prepare financial statements, we have to reflect the substance of those transactions, their commercial meaning, rather than staying at, let's say, at the surface of the transaction, which is the legal form. And that could raise a few challenges in practice. When we look at a transaction, we have to analyze its substance over form and then to reflect it in accordance to this accounting concept in our financial statements. So as you move on into your notes, as I said, a few highlights, you have a few situations which are mentioned in the standards as well, which you would have to challenge. They could be examinable, and you'd have to almost identify the commercial sense of that transaction in order to reflect it in the financial statements. So one type of transaction is when a company sells inventory on a sale or return basis. Sometimes we refer to that as a consignment of inventory. The key thing when we investigate the commercial substance, and to ensure that commercial substance overrides its legal form for accounting records, we want to look at things like risk and rewards. So very much a professional judgment exercise where we want to identify the risks and rewards of that transaction and whether these risks and rewards were transferred by the seller to the buyer in effect. And depending whether most risks and rewards were transferred by the seller to the buyer, the particular transaction has to be recorded as a sale. So inventory sold on a sale or return basis, we would have to identify, remember you have these two dimensions, let's say. You have risks and rewards, if it is to have some sort of, let's say, mini diagram, and of course you have seller and buyer. And in effect, you have to analyze what are the risks and rewards and just place them on the right quadrant and see where you have more risks, more rewards. Are they with the seller or the buyer to know if the transaction took place? So going back to inventory sold on a sale or return basis, you want to see if, for instance, as the sale, legal sale took place, have all the risks attached to that inventory been transferred to the buyer, or for the period of the sale or return, let's say you have a period to return the goods of 30 days, for that period, all the risks are with you, the seller. In other words, if something happens with the merchandise, it's your responsibility, it's your cost. So identifying those things, placing them in the right quadrant, risk and rewards, quantify them where most of them are with the seller or the buyer, would give you an indication of whether to recognize the sale and when to recognize the sale on the seller side. Debt factoring is an interesting one as well. First, to talk about debt factoring, you need to understand what a factor is. Imagine there are specialized companies that will buy the receivables from your company, and they would be specialized in collecting those receivables from your clients. Of course, they will buy these receivables against an amount of money they will give to you, but also they will charge you what we call a factoring fee. And that factoring fee can be quite expensive, could be like 2.5% of the total revenue of the business, let's say. It's just an example, of course, subject to negotiation. But ultimately, to approach factoring or a factor company, you will have to decide a cost based on a cost-benefit analysis whether it's worthwhile or not. And let's say you decide that yes, the benefit of approaching a factoring company is beneficial, and you're saying, I'm going to look for a contract with this factoring company. There are two types of factoring, with recourse and with non-recourse. If it's with recourse, it's interesting to check out the risk and rewards, because with the recourse, it means the factoring company buys the receivable from your company. However, if they don't collect those receivables within a certain time, they may return these receivables to you as a business. And you as a business have to quantify that risk, and if it's likely probable to happen to get that return back, maybe you haven't sold those receivables. Maybe you will have to leave those receivables onto your statement of financial position until you know that the factoring company has recouped those particular receivables, and there is no likelihood for those receivables to come back to you. So it's all professional judgment, it's all risk and rewards quantification. So all these examples is just to get your mind thinking, and we provided you some sort of key questions to ask yourself when you're trying to evaluate risk and rewards. Now make sure when you revise thoroughly, remember express notes are just highlighting you matters. Just get your mind thinking about some core parts of the syllabus. You will have to recap that thoroughly, you'll have to work through questions, but here is a bit of a template or a mindset for you to use as you work through exam standard questions. So the first question you'll have to ask is, do we understand what assets we are talking about? What are we transferring? What's the nature of that assets? Next thing, you're going to this professional judgment on risk and rewards of holding that asset. So what are the intrinsic risk and rewards of holding that asset? As I gave the example, who's holding, if something happens with that particular asset, if it burns, who's gonna be suffering that? Don't tell me you claim that from insurance. That's a separate transaction, remember? But now is that who's holding that risk of the asset? And also, which party on balance is more exposed ultimately to risk and reward? So sometimes if you don't have a clear cut, okay, this risk and rewards lie with the seller or the buyer, then you would be in a position just to exercise some judgment and see who's more exposed to those particular risk and rewards. And I strongly encourage you to go through the exam kit you have and try some questions out on these particular questions. They will be having you to exercise some judgment more than any numbers. So make sure you practice. That's a key of success, to understand substance over form. Also, in this particular chapter, we would like to bring some highlights to you on IAS 18, which talks about revenue. This particular standard groups revenues in different categories. The core categories would be sales that you achieve from goods, and also sales you achieve from rendering services. But of course there are other types of revenues, such as interest, royalty revenue, and dividends revenue, dividend income, and this would be covered also by IAS 18 when you recognize those particular revenues. I would like to draw your attention particularly on when you recognize the revenue from the sale of goods and revenues from rendering services. Now, when you think of by basically selling goods, you're thinking, okay, I sold goods and I raised this I issued this invoice, therefore I'm recognizing revenue. And that's nothing particularly wrong with that. But if you think of a cut-off period, an year-end period, what can happen? You may have raised the documents, may have made the sale, and think, let's say we are making an export just for the scope of illustration, and you may have raised all the documents, but according to your commercial agreement, those particular goods will be your will be in your ownership, and you will be responsible of all the risks of those goods until those goods reach the let's say the destination or the warehouse of your buyer. So if you're at the cutoff of the cutoff period, let's say the goods lived on 31st of December, your year end is 31st of December, but it takes 2 weeks to reach the warehouse, or maybe 1 week, the warehouse of your buyer, and you will be responsible of that. You will argue that for December, even if you issued the documents, that's a legal form, you already see the concept of substance over form taken over in this particular standard, saying, look at the commercial nature. Where are the risks? Well, the risk will be with you till mid-January, when the buyer gets their hands on the goods and therefore take all the risks and rewards of those goods. So as at the cutoff period, as at the year end, would you recognize the sale? The answer is No, not yet. That could be a sale of next year when the whole transfer in terms of risks and benefits took place. So that's a particularity that arises, particularly at cutoff periods, and obviously you discuss and think about that if it's a material transaction. If it's a €1 transaction, just to exaggerate, and you're $1 million business, probably you would not spend time exercising that judgment. But as covered in the framework document, obviously you have to pay attention if you have many small immaterial transactions of similar nature, because on an aggregate basis they could become material, and therefore you'd have to recognize them on a one-to-one basis. And finally, what you'll have here is recognition of revenue services, revenue from rendering services. How is that different? Obviously it's different if you deliver goods versus services, which are intangible. And what you have to pay attention is that you may have situations that a service contract could straddle, for instance, more accounting periods, and what you will have to do in terms of recognizing the revenue of that service, let's assume you were paid the whole service in advance, is you have to create a sort of well, let's say pattern and identify the revenue it's earned in relation to the costs of providing that service. So in other words, if you think, let's say it's a consultancy contract straddling over 2 years period, and the first year passed, assuming you have a pattern of incurring the costs that is fairly similar from a year to another, irrespective of how you're paid for those services, you would have to recognize only a proportion of the revenue in respect of that contract. And if the cost pattern is half and half, maybe a fair basis is to say, okay, I'm going to recognize only 50% of the revenue of that entire contract and 50% in the next period when I incur a very similar pattern of cost, which would be 50% of the overall cost relative to that contract. So that is very, very important. You also comply with matching and accrual principle, and you make sure you're prudent, you're not anticipating profits into your statement of comprehensive income, but more create a matching. If you have a proportion of costs that relate to this period, take a similar proportion of revenues from the contract value into that particular accounting period. Okay, these were the highlights for this chapter. I hope you find it useful. Best of luck with prepping, and look forward to being in touch with you on the next video for the next chapters. All the best and good